Suppose I'm a company, I'm in need of funds, which is why I issue the bonds to you, and I say the coupon rate is, for example, 8% per annum. So as a company, I'll have to pay you 8% of coupon every year for the next 15 years, right? But now imagine that I'm a bank. Imagine that I'm a bank. As a bank, what is my business? Take money from you in the form of FDs or loans and give it to people again in the form of loans and advances, right? So for example, I have issued some bond to you in the with the mindset that I will use that amount to give the loan to the public in general, those who are taking education loan, home loan, etc. So I took the loan from you at the rate of 8% fixed. But then what happened that due to change in economic conditions, now imagine that economic conditions started to improve. RBI decreased the repo rate. Interest rate globally are reducing down, which means do you realize that market rate of interest in general are reducing down? So someone in the market, if he wants to take a loan in the market, what will happen? He would want to borrow at a lower rate because RBI rate have fallen down. Rates in the world, across the world in general, have been falling down. So he now wants to borrow at a lower rate. Now, as a bank, imagine what happens to me. I borrowed from you at the rate of 8% for 15 years, right? After 2 years, the rate of interest in the economy has fallen. When I lend it to the when I lend this amount to someone, I am able to lend him only at the rate of 7%. Which means, are you people realizing? Forget making profit. I'm rather making losses on this amount because of interest rate which is changing in the economy. Could I please explain to you the concept I'm trying to, everyone? This concept which you have learned is also called as interest rate risk. That since rate of interest in the economy is changing, as we discussed this yesterday, as a result of which you should already know that the price of the bonds also change, which is a problem to us, correct? As a solution to this, what has bank come to like what kind of bonds were introduced? Sir, variable coupon bonds have been introduced. So these bonds coupon is determined, predetermined, but is not fixed. For example, I will say that my coupon rate will be whatever repo RBI decides plus 2%. Now, if the economy improves, right, if repo falls, I will have to pay you a lower coupon rate. So if repo in the economy is 4%, I will have to pay you 6%. If repo in the economy turns out to be 3, I will pay you 5. If repo turns out to be 7, I will pay you 9. Which means my coupon amount is predetermined through this formula, but the amount of coupon will change due to change in repo in the market. Every year, the bank will decide the repo, and for that year, accordingly, my coupon rate will get decided based on repo. Could I please explain to you? So with the fluctuation in the market, if I receive, so for example, I give loan at a lower rate because the market rates have fallen, I will have to pay you on this bond a lower rate. Are you understanding? Everyone in the class requesting your response. In the coupon bearing bond, could I please explain to you both the types of coupon bearing securities? Everyone. Quick, please, I need a response. How much out of 10 are you people able to differentiate between the two types of bonds? Yes. Now you need to understand something very important in this. I can explain it to you mathematically, but I understand analytically you are becoming stronger enough to understand it logically. Everyone. Everyone. So yeah, Dhananjay, ultimately fluctuation cost is borne by customer. But it is a benefit to customer as well. Let me teach you how is it a benefit. Do you remember I said YTM changes in the market? We took the example of Russia versus Ukraine war after the, you know, the world suffered due to this crisis, right? And the repo in India increased from 4 to 6.5, as a result of which people's required rate of return also increased and the bond market fell down. You remember that we did yesterday. people, or maybe day before yesterday, whenever, right? Let me now tell you, for a fixed coupon bond, the coupon amount is fixed at the rate of 8%, right? So let's now imagine that at the time of issue, YTM in the market was 10%. So I kept the coupon rate to be 8 sorry, at the time of issue of the bond, YTM was 8%, so I kept the coupon as 8%. Can anyone in the class tell me my bond would be issued at what price? Can anyone in the class tell me what is the price at which I will be able to issue my bond as coupon is 8 and YTM is 8? Sir, at a face value, for example, of rupees 1000, as we just learned it on par, correct? Now imagine that, so coupon rate once decided cannot change. I will continue to pay 8% of face value if it is a fixed coupon bond, but later on in the economy, YTM can fluctuate, right? YTM is the required rate of return of the investor, which can change every day with the change in risk. So if YTM increases, value of the bond falls. If YTM decreases, value of the bond rises, and so on. Now please try to apply the logic. If it is a variable bond, do you agree? Coupon is not fixed. Coupon is predetermined but is linked to a market rate. Is linked to a market reference rate like repo plus 2%. So repo is linked, like repo is one of the market rates. YTM is or nothing but YTM is also a market rate. Now please imagine this. If interest rate in the market increases in general, which means repo increases, and at the same time YTM also increases, which means, do you realize, if discounting rate is increasing, the compounding rate is also increasing, and the impact on the price won't be significant, because both the coupon rate and both the YTM are changing in a similar fashion. Everyone. Suppose economy improves, RBI reduce down the repo rate. So if repo rate falls, which means my coupon rate falls, but at the same time required rate of return of the investor will also fall, because in general market interest rates are falling. So when coupon will also fall, YTM will also fall, both of them when fall simultaneously, can I say the impact on the price won't be as much, because compounding rate is falling, discounting rate is falling, somewhere maintaining my value around the par. Could I please explain to you this logically without involving math into it, numbers into it? Please, everyone. And if you think, are you able to process this, because I'm going to anyway give you justification of this with the help of an example, with the help of that question, which we'll do. Yes. So why, see, I am now being explaining, I am now, being interested to explain certain things which I was not explaining till like a year back. Because with the introduction of MCQs, I want you all to be capable enough to know certain things, which I don't know if institute is brilliant enough to ask such things, but you guys should be brilliant enough to answer such things. If I ask you a simple question, which of the two bonds will be more fluctuating in price, fixed or variable, the answer will be fixed. Because for fixed, coupon is constant, the discounting rate changes, so price will change. But for variable, both coupon and discounting rate change in the same way. One is compounding rate, one is discounting rate. The effect on the price is not as much, is my point. Correct? So now I feel interested to explain such things to you. And I don't know if they would even ask a question like this or not. Less sensitive to change in YTM, fixed coupon. is more sensitive to change in YTM? Correct? Everyone, please. Interviewer might ask. Yeah, but we have to consider it as a 200-hour, a very exam oriented batch. I hope you realize that this triangle sign is the sign of delta which represents change. Can we please speed up, everyone? Less sensitive to change in YTM.